kind of follow up on what we were talking about at the top of the show, how much of the market is actually reading some of the lag factors that could come in when you think about where the economy is headed. Yes, we are starting to see the slowdown. Yes, the expectation is the Fed is likely to hold the rates going into year end, but there's still a lot of uncertainty about what current existing monetary policy will likely mean in the next several quarters. Do you think there's a bit of complacency that's kicked in?
No, I think there's a tremendous amount of complacency that's kicked in, Akiko. As a matter of fact, I call this the sweet charity market, like from the 1967 film. And there's a song in there that says, "Hey, big spender." Now, I listened to your piece before where you said, hey, look, spending has come in a little bit on some of the high ticket items like Tesla, some of the things like NEO. There's also been a sort of a slowdown in spending in travel, in terms of airlines, in terms of lodging, things like Marriott, Hilton, Airbnb. They've all come in about 15 to 20%. And so I can see some of the big ticket items have come in terms of travel services and what I call a status. But one thing has not slowed down, Akiko, is the spending in what I call technology or in designer brands whatsoever. You're looking at stocks, TJ Maxx, Abercrombie and Fitch, Lululemon, these high status kind of companies, brand designers. They just never tick down. People continue to spend regardless of the actual rate hikes that have occurred. I'm not sure exactly why, but at some point, consumers are going to have to look at their credit card balances and think to themselves, well, if I don't pay off at the end of the month, what might be the ramifications? And their balances are going to build. And the other side of this is the lowest savings rate in the United States in over 40 years. We're down at about 2.5 to 3%. So everybody's pretty much tapped out on his or her credit cards. So although spending has been curbed in some areas, it's not been curbed in all areas. And with the low savings rate, to me, it spells some type of like corrective mode that's going to take place if we cannot maintain jobs at a certain high level. So expect the job number to slow down, expect spending to slow down. It's just not being reflected in the market just yet. Give it time.
So, Jeff, what could then be reflected when we talk about the chance of a possible correction? What does that correction look like?
I don't think it's going to be that serious of a correction, just a demonizing thing. However, let me put this in perspective, Seana. This is the greatest bifurcation that I've ever seen in 35 years between value stocks and growth stocks. Portfolio managers are treating growth stocks literally like they're the ugly redheaded stepchild or cancer. They want to have nothing to do with it. As a matter of fact, the lower the value stocks go, the higher the growth stocks go. The market is sending a message that we don't want value at any cost. We don't. We want growth at any cost. And if you were to ask me what the linchpin is that's going to get the market to turn on its heels and finally get that corrective mode, it's probably going to be somewhere between the mean reversion of the growth stocks coming down and value stocks becoming back into favor. That's where I see the market start to do its kind of corrective mode. And I sent you a graphic that there are two sectors that carry the market this year. If you remove there's 11 sectors in the S&P, technology and consumer discretionary are responsible for the entire gain in the S&P. Absent of those two sectors, the S&P is actually down for the year. So at some point, the consumer discretionary sector, the XLY, is going to have to make a move. And the XLY is made up of things, like I said, high-end, the Lululemons, the Nikes, the Abercrombie and Fitches. Those things are going to have to correct at some point, and value at some point will come back into play. For some apparent reason, dividends have no interest to portfolio managers. I'm not sure why. Yeah. But in a corrective mode, that would seem the place to park your money.
So Jeff, is all that to say that you see opportunity in value right now, and that's where maybe investors should be looking?
Oh my goodness, do I see opportunity? They've been shunning utilities all year long. Nobody wants to touch utility because interest rates have been rising. But the fact of the matter, AT&T and Verizon actually offer tremendous yields. Their cash flow is steady. And if the market does go into a corrective phase, this could be the place to park your money to get a lot of upside, as well as a very kind of juicy dividend. My other two areas is they've been shunning, except for Eli Lilly, Akiko, all year long, all year. Nobody wants to have anything to do with pharma. Pfizer, kicked to the curb. Bristol Myers, kicked to the curb. Those are the places where the greatest value opportunities are because they're at single-digit PEs and yields that go from 3 to 6%. So I think that if the recession siren is sounded, you're going to find great value in pharma and in utilities, and that money will actually come out of the XLY and come out of the XLK because it's just been overcooked for too long.
So some opportunity in some of those recent beaten down plays. Jeff Bierman, always great to get your perspective. Thanks. Have a good weekend.
Thank you, Sean. Have a nice day.